Very much to Fast Markets for inviting me onto the conference. I'm going to be speaking about lithium cost curves and related matters, and my name is Rodney Hooper from RK Equity. Lithium cost curves are open to many interpretations. Given the disparity and the disconnect between published cash costs and operating margins, it's definitely an area worth reviewing. The way we see it is once you've determined where a product is sold, the most important statistic is determining what the effective sale price is that results in a company being in a cash neutral position after covering all relevant cash costs. The lithium industry is unlike other metals. It's made up of a vast range of products of differing quality sold at a wide range of prices all over the world. Depending on their location and corporate structure, producers effectively pay sales commissions, variable lease payments, import duties, and export taxes. For traditional commodities like copper and nickel, cash costs linked to a standardized product, such as the one on the LME, have a direct bearing on a company's profitability. The truth is, in the lithium industry, cash costs can be a red herring. Low cash costs do not guarantee high operating margins or after-tax free cash flows. Why is this the case? For producing assets, there are a number of cost curve issues to deal with. The first is a bifurcation in pricing. It can be between the same product in different geographic locations, the difference between battery and non-battery grade, between lithium chemicals such as carbonate and hydroxide, and then the product itself, whether it's a specialty chemical for grease or ceramics, pharmaceutical or battery. Beyond that, there's a variable royalty or lease rates and export taxes and commissions based on the sales price and the location in which the sale happened. And that creates a moving target. In addition, you have variable exchange rates, particularly in volatile countries, and we've seen how much the currency's moved in Argentina, and the other things like input costs, diesel and sulfuric acid and so on, and those are all moving targets in addition to the others. And another one to consider is variable feedstock for non-integrated producers in China. They have spodumene concentrate offtake agreements. Those agreements are linked to formulas based on price, and those change with each and every price change. So again, a moving target. So what we're looking at overall is that lithium is unique. Different cathode and products mean different customer specification sheets, and that means different complexity in delivering required materials. There's an opportunity to spend in additional cash costs to generate a higher price for the sale good. And if you look at the lithium industry last year, roughly 300,000 tons, roughly $3 billion of value, split into a number of areas: industrial, battery, primary battery, etc. So a large number of sale markets in what is already quite a small industry. If we look at an example of what happened in Q2 2020, and we look across a range of producers and looking at estimated based off the financials that have been published, the cost per ton sold versus the EBITDA, the earnings before interest, tax, depreciation, amortization margins. On the left, you have Orocobre, a single asset producing carbonate. As you move across the SQM, you introduce hydroxide and so on, going down the line, Albemarle, specialty chemicals and industrial, and then Ganfeng and Livent also doing lithium metal. And despite the fact that the costs are rising from left to right, if you look down on the lower half of the chart, you've got an EBITDA that looks very different, and there's no direct correlation between who the lowest cost producer is and what the operating margin or EBITDA margin is. Now, of course, Albemarle has fixed price contracts in there, so that can be some sort of an anomaly if you look here, but it still makes the point that selling a different range of products into a higher value segments can mean that the all-in cost is not indicative of what operating margin will be. Looking at the low cash cost routes to producing carbonate and hydroxide, to the extent that these are standardized products for battery quality carbonate and hydroxide, then cash costs are more highly correlated to break-even net prices and operating margin, but not completely accurate. Cash costs are only representative of reality for the exact fixed underlying price used in the calculation at the time of the graph. And what do I mean by that? Well, let's look at a live example. If we look at the all-in costs over the price cycle for carbonate, I've chosen 3 companies here. You've got SQM, a single asset in the Atacama, and subject to lease royalty payments. Here they are here, under $4,000 a ton, that's 6.8%, and that climbs to as high as 40% above $10,000 a ton. Then you have Albemarle, which is partially exposed to the Atacama and then has Greenbushes and processing in China, so partly fully integrated and partly exposed to the lease royalty. And then lastly, Ganfeng, partially integrated as well with Mount Marion on a consolidated basis, and then non-integrated through its exposure to spodumene concentrate, buying from Pilbara and UTURE on a formula basis. And if you look here on the left, in very difficult and tough pricing times, SQM is the lowest cost producer. But as you can see in the table, as the China price, VAT inclusive, goes up, you go up to as high as $30,000 a ton. The all-in cost of goods sold goes from about $3,750 to just under $12,800, thanks to the lease payments. So what you have, when you compare the company's position on the cost curve during the price cycle, you've got SQM being the low-cost leader in low price times and then becoming the highest cost producer during very high price times. And why is that relevant? Well, for investors and people looking for it, looking out to see profitability and how much margin is converted from increase in price, anything above $10,000 a ton and more than 50% of the price increase with respect to SQM gets a portion to either the lease payment or to VAT in China. So as prices increase on a volume for volume basis, you can see different companies benefit in different ways. What are the issues around greenfield projects and their place on the cost curve? I think it's important for people to remember that cost curve providers are like accounting auditors. They don't prepare the data. It's management and their advisors that execute feasibility studies. It's also important to note that there's a limited universe of producing assets. For hard rock and brine, for clay, there's 0. And that limited universe of producing assets is in a large number of diverse locations with diverse flow sheets. There's also varying levels of infrastructure, labor costs, etc. So there is a risk from a greenfield's perspective of a junk in, junk out when you assess expected costs. And where a project sits on the cost curve is less important than what its operating margin is. As you saw in the earlier chart, you can go bankrupt sitting at the low end of the cost curve, producing an even lower value product. So what is the main issue around greenfield projects and cost curve and their fixation on it, as we see time after time publications trying to show how low down on the cost curve they are? It's because all new projects assume they will qualify all their production into the high-priced battery supply chain, and hence the fixation on cash costs and the assumption that low cash costs has an immediate translation into a high operating margin. But greenfield projects, the cash costs will only come into play once a greenfield project has been funded and constructed. In order to secure funding, a greenfield project has to generate a sufficient after-tax internal rate of return, or IRR, at the project level. If we look at anecdotal evidence, 2 times the weighted average cost of capital, or 15 to 17% roughly, is where we work off for Albemarle's guidance, is the required internal rate of return for a well-established and proven flow sheet. In our dealings with potential funders, we have confirmed these rough metrics as correct on an all equity funded basis. So under this scenario, cash cost curves for greenfield projects can play a limited role in determining whether something's financially viable on an IRR after tax basis. And we're going to give an example and look at that now. So going back to the Albemarle cash cost curve, we have taken an example of 2 different potential operating assets, the one being an Argentinian brine located here lower down on the cash cost curve, and the other a Chinese non-integrated hard rock project sitting at slightly double the costs. Before we get to analyzing the cash cost and the IRR, the first thing one needs to also address is what is the net price received by a producer selling in China. And given that we're looking at 2 carbonate projects and that the vast majority of carbonate-based cathodes are produced in China, it's relevant to look at what the net price to the seller would be in the Chinese market. So if we take a China spot price inclusive of VAT at $12,000 a ton, and then deduct VAT, and then of course the buyer will have the free on board plus freight and insurance import duty to pay, and then the freight and insurance, what you end up with is a fee on board price for the different sellers, and then beyond that, each producer will be subject to an export tax or a lease payment or a ad valorem tax at in the country from which they sell. We've assumed in this example that Argentina will reintroduce an 8% export tax based on dollars. SQM will of course be exposed to its lease rate, and in Australia we've assumed 5%. So what we end up with here is the net price to producer. You start at a $12,000 including VAT price in China, but you end up cash in hand to the producer of somewhere between 8.8 and 10.6, depending on where you're producing from. So there's a material difference in what the end price is for the seller. And I think that's important when investors are analyzing projects and seeing reports about what the sale price will be for the company they're looking at. You need to make a close assessment of what's going to be paid before they actually receive their net cash. Now on to the internal rate of return and where cash flow neutrality is achieved. We have the net price to producer from the previous screen, and then going down the list with the various income statement line items. We've assumed for cash costs plus SGA and transport $4,000 a ton for the Argentinian brine, $3,000 for SQM, $8,400 for China. That's a 600 spodumene concentrate per ton price plus conversion and transport, and then in Oz 6. And then going down, as I say, through the line items, straight line depreciation over 20 years, the different tax rates, sustaining capex, and then your free cash flow, and then importantly looking at what capex will be in each of those locations. You range from 5,000 for SQM up to as high as 25 for Oz. That's an integrated project with a mine concentrator and a chemical converter. And what happens is, despite a material difference between a Chinese non-integrated and the Argentinian brine, because of the substantial difference in capex between the two, you end up at the same internal rate of return. And it's interesting to note that even using a $12,000 China spot price, they're not quite getting there. Sorry. They're not quite getting there in terms of the 15% hurdle. Yes, if you look below, what is the break-even China spot price, including VAT, where the company will be cash flow neutral? There, the Argentinian brine is materially better off and more resilient in a down cycle versus the China non-integrated. And in that example, I've started because I've used a lower spodumene price around where levels are today. And you can see where SQM and Australia is. It's also interesting to see, given, despite the fact that SQM will pay a 40% lease rate over $10,000 a ton, and scaling up, they still have a substantial IRR at those prices, given its very low capex to do brownfield expansion. So it just shows the resilience of that asset. But interesting to note that despite the doubling of the cash costs for China, it comes out the same on an IRR basis. So what we did is have a look and said, what is the Chinese carbonate spot price, including VAT, that's needed for projects to achieve a 15% after-tax IRR, which we consider the hurdle in which funders would require in order to support a project. If we look here, not surprisingly, SQM in a strong position, and then China brine and so on, with all of the different projects, some of them brownfield, some of them part brownfield and greenfield in terms of spodumene concentrate and chemical converter. This doesn't speak to quality. It just assumes that the quality standards will be met. It's purely on the mathematics. And what becomes clear is outside of these brownfield expansion, you have the greenfield projects and the non-integrated, and they're all huddled around $12,000 a ton or more for China spot price, including VAT. And in this instance, with Ganfeng, we've assumed $600 a ton for spodumene concentrate. Whether or not that will be the case, selling at a spot price of 11.5 or so, or 11.2, that would be interesting to see. If you up that spodumene, of course, then that number will go closer to 12,000. Are the Chinese non-integrated projects prepared to construct and build and earn less than 15%? Possibly. You'd have to make that decision for yourselves. Does this change materially if we switch this from carbonate to hydroxide? It does for some of the entities that go through the carbonate process first. But if you look at what the required hydroxide price would be needed ex-China to achieve this 15%, then it's pretty similar. It has a similar profile, and most importantly, you'll see that the marginal projects again cluster around this $12,000 a ton number. So what does this mean for future prices and supply chain implications? If you look at how fast battery quality demand is growing, and you are prepared to accept the thesis that brownfield expansions from existing projects and the increased capital, the utilization rate of existing capacity in China, etc., is insufficient to meet the rate of growth of demand, which is the thesis we believe. Looking at numbers, we're seeing more analysts coming to the same EV forecasts, etc., that we do. The difference we still continue to see is that the lithium intensity per kilowatt hour, we think that analysts are still neglecting the reality of production scrappage at the cell level and production losses. in their estimates using first principles. We think those numbers need to be higher. And we also think that there's a too low an estimation of what inventory builds need to happen as the amount of lithium sold into the supply chain, and particularly into EVs. You will need inventory build across the entire supply chain. If you accept that thesis that marginal production will need to come online, then $12,000 a ton or more is the China spot price inclusive of VAT that's needed for companies to generate free cash flows on a new greenfield project basis. So we agree with Joe Lowry's new normal, 12,000 plus. Our maths and our analysis of it suggests that that's roughly what's needed in order to get enough projects online to meet supply. If we look at what is needed to maximize EBITDA margins in high lease and export tax locations, it makes financial sense to build inventories offshore during low prices. For someone like SQM that has a lot of working capital, they can export and pay less lease rates and sit with the inventory and wait for prices to rise and enjoy that upside without the cost. And then for someone like Orocobre, provided they can execute, it makes sense to ship low quality product out of an export tax location and then do the repurification near the final downstream client ex-China to maximize EBITDA margins. Will countries and continents without sufficient local resources, for example, Europe or the EU, ensure the security of supply with incentives and tax breaks for local chemical conversion and reprocessing? We think that will be the case. We think in-country or EU Union or free trade production and sale will be supported by subsidies, soft loans, tax breaks, and of course, reduced transport costs. And on that basis, we think two areas of particular focus that we pay serious attention to at RK Equity is both North America, US and Canada, and Europe, as projects there will be the beneficiaries of this. It's not just incentives, it's also a question of time before carbon border tax or carbon emissions are assessed and fined or penalized, and possibly some of their own tariff protection in terms of supporting a localized industry. And on that basis, it's possible for a project that looks optically like a tier 2 project to actually offer tier 1 returns. And it's the reason why we give particular attention to those two markets. And finally, if you look at each producing company, it has a very fluid cash and all-in cost curve depending on various factors. And investors need to analyze the individual cost curves of each company to properly understand the full cycle profitability of those companies. Thank you very much. There are our details if you wish to be in touch. Thank you.